Good afternoon, everybody. We'll give everybody else one more minute and we'll get started. Good afternoon, everyone, and thank you for logging into today's presentation. We will be hearing from Ruben Nizard, Coface economist for the North American region. Ruben will share with us critical information regarding the economic impact of the current COVID-19 pandemic globally, as well as specifically to the United States and Canada. I would like to go over a few items so you know how to participate in today's event. We've taken a screenshot of an example of the attendees interface. You should see something that looks like this on your own computer desktop in the upper right corner. You're listening through your computer's speaker system by default. If you prefer to join over the phone, just select telephone in the audio pane and the dial-in information will be displayed. You will have the opportunity to submit text questions to today's presenter by typing your questions into the question pane in the control panel. You may send your questions at any time during the presentation. We will collect these and address them during the Q&A session at the end of today's session. And now, allow me to introduce Ruben. Ruben joined Coface in 2016 with the Group Economic Research Department located in France. He has been responsible for Coface country risk analysis in Africa, as well as contributing to the Coface analysis of the oil market and the Coface Political Risk Index before being appointed to his current role. Ruben holds a master's degree in economics and business from Sciences Po Paris. Sciences Po is an international research university ranking globally among the finance institutions in the social sciences. Ladies and gentlemen, Ruben Nizard.
Hello, good afternoon, everyone. Thank you for joining us today for this presentation and webinar on the impact of the COVID-19 crisis and the economic impact of the COVID-19 crisis. I will like to say before I begin presenting the slide that all this presentation will be available for download in the handout sections by the end of this presentation. So the pandemic that we've experienced this year triggered the first global recession since 2008-2009 and the great financial crisis of 2008 to 2009. As lockdowns ordered throughout the globe caused an unprecedented shock on activity. As you can see from the left-hand side chart, we expect global GDP in 2020 to contract by 4.6%. So this is the worst since this last recession, the great financial crisis, as you can see from this chart. But this will also be the worst contraction actually since World War II and since the World War II era. So really an unprecedented crisis. It is also unprecedented from because of its broad-based impact. And that's what you can see on the right-hand side chart. You can see that it is a truly global crisis with most countries in the world that are going to expect a full year contraction in 2020 and very severe contractions in 2020. So you can see it from this subset of major countries throughout the globe, both in developed and emerging markets. But if we look at Coface forecast and Coface individual forecast, we have more than 140 countries that will record negative growth rates in 2020. It shows the extent of this crisis and how broad-based it is. So the second takeaway from these two charts is 2021 and the recovery. You can see that we expect in 2021 4.5% growth, and you can see from the right-hand side chart that most growth rates in 2021 will be lower than the contraction that was recorded in 2020. What it means that by the end of 2021, we will still not be back at the level of activity that we had prior to the crisis. So the very deep impact of this crisis will continue to be felt through 2020, through the second half of 2020 and in 2021. Even though we will recover, we won't be back to the level of activity that we had at the end of 2019. So if we look more specifically at what happened in the first half of the year, and if we could move on to the next slide, we'll see what happened in the first half of the year. And what you can see here, and I want to insist particularly on the chart on the right-hand side graph, is that there is a relation between the stringency of the lockdown that is indicated by on the horizontal axis by this index score that is calculated by the Oxford University, and GDP growth. The more a country was closed during the pandemic, the more the deeper the impact. So you can see, for instance, that in Europe, and especially in Italy and France, where the lockdown was more pronounced in the first half of the year, well, GDP upturns were more severe than in other parts of the globe. Looking more specifically at North America, in both Canada and the US contracted sharply, even though at a lower, even though less severely than in some European countries like Italy, France, and Great Britain. For instance, the US GDP declined by 10.2% in the first half of the year, while Canada's GDP declined by 13.4% over the first 6 months of the year. You can see on the left-hand side chart these the quarterly figures at an annualized rate, and you can see how deep the shutdown, how deep the impact of the shutdown was on both the Canadian and the US economy. What is also very important to get away from these two charts, and especially from the chart on the right-hand side, is that it helps to understand why the recovery, the path of the recovery, will be uncertain. The pace of the recovery will depend very much on the evolution of the pandemic and on the decisions, on the policy decisions that are taken by governments worldwide. So for instance, we can see that already in Europe, where there is a second wave, particularly in France and Spain, we can see in Canada the number of infections is also ticking up, prompting some provinces to implement more restrictions. So that's what makes the path of the recovery very, very uncertain. But with that being said, we have laid out a scenario that I believe will be useful to understand Coface's position on the recovery. If we can move on to the next slide, you will be able to see how we inform this scenario. So we inform this scenario based on some high frequency indicators and other elements that I will cover in a minute. But what we've seen so far with the recovery is that after the drop in activity and the very severe drop in activity that we've seen in March and April, well, since late April, we've seen a very rapid bounce back from the lows that we've reached in April. And well, this very rapid bounce back, you can see it lasted up through the end of June, basically, in both the US and Canada. But what we can see is that there is a second phase of this recovery that started in the summer, and especially in the month of July, and the recovery became more gradual and more uneven when you look at it from one country to another and from one sector to another. So for instance, you can see from this chart that the number of small businesses open in the US trended downward from in July as a result of the increase in new infection that we've seen in many states in the South, in the West, in the Midwest this summer. But you can also see that in Canada, where the number of infections remain under control in the summer, and is only starting to tick up right now in the past 3 weeks, well, we are seeing the same movement of slower growth in activity in Canada. So that's why we expect in the future this gradual recovery to continue, and levels of activity to continue to trend below the level of activity that we had at the end of 2019 and at the beginning of 2020. Why do we expect that? So especially in North America, the main reason why we expect this recovery to be very gradual and very uneven is because of the impact that this crisis had on the labor market. So if we can move on to the next slide, you will be able to see on the left-hand side chart that the shock on employment is unprecedented. So you can see that employment compared to previous recessions fell by about 15%, far more than in the previous 4 crises that we had. You can also see that there's been a rapid bounce back in employment, and about half of the jobs that were lost because of the result of the pandemic were recovered in the months of in June, July, and August. But as you can see from this chart, while the level of employment is still 7.6% lower than it was in February. And one interesting factor that we've seen is that the pace of the recovery in the labor market is getting slower, and indications from the weekly initial jobless claims figure that we see is that it continue to slow in late August and in early September. So the result is that we have a very high official unemployment rate. So it is now standing at 8.4%, as you can see on the right-hand side chart, after it peaked at about 14.7% in April. But what is important to note is that whatever the way you look at the unemployment rate, well, it's still at the levels at unprecedented levels. This level of 8.4% was not seen since the last financial crisis, and this level of 8.4% is probably lower than the actual unemployment rate. Why is that? It's because, well, there are several reasons. The first reason is that there was problems in the collection of the data. So it means that the actual unemployment rate is probably higher than official figures suggest. And the second reason for that is that we have a lot of people who left the labor force in March and April, leaving the unemployment rate figure not giving the full depiction of the reality. So that's why when you look at the realistic unemployment rate that we calculated, taking into account these factors, it's still close to 10%, and this level, well, it's unprecedented since World War II. So still very high level of unemployment, and even if all the people that were temporarily laid off, because of the crisis and because of the shutdowns, well, we can see that in the U.S. we would still have a still very high 6.6% unemployment rate in the U.S. So this very deteriorated labor market is obviously having an impact on the economic activity, because, as you're well aware, economic activity in the U.S. and in North America in general is very dependent on household consumption. In Canada and the U.S., it accounts for roughly 70% of total GDP. So these are the key indicators to follow the recovery. The good news for the North American markets is that, well, labor markets are more flexible. So it means that, contrary to what we are likely to see in Europe, unemployment rate has probably already peaked in it has probably already peaked in the US and Canada, but in Europe we can expect the unemployment rate to continue to trend higher in the months to come. So that's probably one of the good aspects that we have, is that the trajectory of the labor market is going in the right direction, but still it's still at a very high level. And even should all the people that were temporarily laid off because of the crisis return to work, we would still see a very high unemployment rate in the US and Canada. And it is having an impact on income of households. That's what you can see on the next slide. So with this next slide, what you can see, especially on the left-hand side chart, is that because of the crisis, the wages and salaries of households has declined. So it has declined, but it has been offset in the US by the unprecedented fiscal measures that were taken with the CARES Act in late March. So the one-off check that was sent to American households in April and expanded unemployment benefits contributed to structurally increase the income of American households in April. But since April, you can see that the income of American household is now trending lower. So that's why the deadlock in the stimulus bill talks that is experienced in Congress is a problem for the recovery. It's because without any further support for American households and with an unemployment rate that is still standing at record levels, well, we can expect income for American households to trend lower. And it's a very bad news for consumptions, because as you can see from the chart on the right-hand side, well, households are already forced to tap into the savings that they have accumulated in April. So as a result of the increased transfers from federal and local governments that we see, you can see that the saving rates of households has increased to a record level of 34%. But then, because these support started to trend lower, and that the impact on their actual wage was starting to be felt, they had to tap into these saving rates, and that's why it's now trending lower. And that's why the recovery will grow more gradual, because these saving rates that was built thanks to this transfer and thanks to government transfers, well, they help to support pent-up demand in the first months of the recovery. But now, with pent-up demand slowing and with the savings rates trending lower, we can expect everything, and especially the consumption side, to trend lower. The second risk and one other risk that we want to highlight in this recovery is not related to the pandemic. And for this, I would like to move on to the next slide, where it will be the second risk that we see to this recovery, especially on the North American market, is the US foreign policy. So obviously with these charts, with these two charts, you can see one main aspect of the foreign policy that has been an element of slowing growth in the US, the US-China Trade War. So you can see that the level of tariffs have increased dramatically and remain still very high, in spite of the phase one agreement that was passed at the beginning, that was signed at the beginning of the year. But the problem that we have is that as a result of tensions arising because of the pandemic and from long-standing tensions between the US and China, we are seeing an escalation into these tensions. So we can see an escalation in this tension on the trade front, where well, trade remains very well, despite the phase one agreement. It remains difficult for for China to increase its purchase from the US. So this will be an element of difficult negotiations in the next couple of weeks between the US and China. But we've seen also these US-China tensions going into other fronts. So we've seen more sanctions being implemented because of tensions surrounding the status of Hong Kong. We've seen more tension surrounding some security concern that the US have, especially regarding Chinese tech companies. So this is all weighing on US foreign policy. But in addition to US and China tensions, we are also seeing these tensions growing with other countries. We've seen, for instance, and quite notably for North American markets, trade tensions escalate with Canada this summer, with the US deciding to implement tariffs on Canadian aluminum, and Canada decided to retaliate to these tariffs that were implemented again after they were suspended for about 18 months. So all of this is gonna continue to weigh on the recovery, particularly in the US and in Canada. And well, we'll see how it goes with the elections in less than 2 months, and if there's a change of administration. But even should the administration change in January, we do not expect these trade tensions to and tariff level to de-escalate quickly. It will take time for these level tariffs to go down again, and it will probably take a long time before trade relations normalize. So that's one very important aspect. And even though it's very uncertain because of the elections in November, well, we still have the view here in Coface that U.S.-China tariffs will remain a problem and will remain in place in 2021, even though the administration might be more willing to engage into negotiations. So these are the main risks for the recovery that could make the recovery slower in the US than in other parts of the globe, and in North America than in other parts of the globe. These slower activity that we are going to see in the US and in North America is going to have a big impact in the future for businesses. And one of the key impacts that we're going to see in the second half of the year and in 2021 is increased bankruptcy. So if we move on to the next slide, you'll be able to see Coface forecasts for business insolvencies in the months to come. So here you can see that we forecast that business insolvencies at the global level will increase by 33% between the end of 2019 and the end of 2021. This increase in business insolvencies will be particularly high in the US, where we expect these business bankruptcies to increase by 43% by the end of 2021. In Canada, we expect a lower increase of about 14% by the end of 2021. Why did we publish this increase in bankruptcy from 2019 to 2021? Well, it's because we've seen something very strange in the first half of the year. At odds with GDP growth figures that collapsed in the first part of the year, we've seen business insolvencies falling, and even falling very dramatically in some countries. You can see that, for instance, in France, South Korea, Denmark, well, we've seen business insolvencies decline by more than 33%. Why did we see that? In Canada, it was minus 27%. Why did we see that? So there are several reasons again. One of the main reasons, especially in Europe, we've seen the insolvencies legal framework being temporarily changed to accommodate businesses in these unprecedented times. But the risk that we face in the months to come is that as these temporary changes that were put in place into the legal framework of business law are gonna dissipate, and it's gonna have and it means that business insolvencies are gonna rise quite sharply by the end of the year, are gonna start increasing quite sharply by the end of the year, and in 2021, as the liquidity position of many companies grow more precarious. You can also see the second reason for this decline that we've seen in the first part of the year is also because of measures that were taken as a result of the crisis. Many governments considered unprecedented policy support, fiscal measures trying to help companies alleviate their liquidity positions, and it helped them to avoid bankruptcies in the short term. But as the reopening goes on and as bankruptcy courts reopen, well, we can expect these business bankruptcy to rise, and quite rapidly. So that's why we also expect activity in the months to come to be important, and but more importantly, what we will be looking at is the evolution of business bankruptcies, which is likely to rise quite significantly. Looking more carefully at what happened in the US, and we can go on to the next slide for that. In the US, there was no changes to the business bankruptcy proceedings, and yet we've seen a decline in business bankruptcy filings. You can see from the left-hand side chart that 2020 business monthly commercial bankruptcy filings are trending lower than in the past 3 years. But actually, what is important to note is that in the case of the US, well, this decline can be explained by some fiscal measures. It can also be explained by bankruptcy courts operating at lower capacity during the lockdown. But it's also important to note that during the first half of the year, there's been a very interesting development in terms of bankruptcy in the US. You can see that Chapter 7 bankruptcy, which are liquidations and companies liquidating their assets to pay their debts. Well, you can see that these types of bankruptcy filings are trending significantly lower. But in contrast, Chapter 11 bankruptcy filings, which are restructuring of debts by companies, have increased quite substantially. So the overall decline in business bankruptcies that we've seen in the US is mainly a result of slower liquidations, but it doesn't mean that we have a lower amount of debt restructuring as a result of the pandemic. And it bodes ill for the months to come, because many of the debt restructuring that we are seeing right now are likely to translate into liquidations in the future. And that will probably drive the increase in business bankruptcies in late 2020 and in 2021. That's why we expect this very sharp rise in business bankruptcy in the US of 43% between the end of 2019 and the end of 2020. If we look in terms of sectors, which sectors are going to be most affected by these bankruptcies? Well, to give you some insight into Coface view of the sectors most exposed to bankruptcies, you can look at our sector risk assessments that you can see on the next slide. So from this slide present the sector risk assessments that we update on a quarterly basis for 13 industrial sectors, and that represent the business default risks ranking from low risks to very high risks. So if we take a look at these assessments, you can see that for North America, the sectors that we expect will experience bankruptcy in the months to come are, without any surprise, the retail and textile clothing industries that are ranked in very high risks. Both these sectors were in difficult positions before the crisis, and obviously the lockdown has made their position even more precarious. And we expect business bankruptcies that are already trended higher in Canada, and Chapter 11 bankruptcy filings, which have already increased in the US in retail, to continue increasing in the months to come. Also, we remain very cautious on the automotive sector, where we expect the impact on the labor market to be felt on car demand. In addition, we can expect the very low level of tourism activity to weigh on demand from car rental companies on cars. So this will affect very deeply the automotive sector, having also an impact on some other sectors, including that are very important for the automotive industry, including the chemical sectors, the metal sectors that you can see are ranked into high risks. You can also see that we have downgraded the energy sectors in very high risks, because we expect business bankruptcies in both the US and Canada to accelerate in the months to come. And actually, in these sectors, they have already accelerated. So in the US, it reflects our view that the shale oil sector will continue to experience difficulty with oil output trending significantly lower, and which has already declined by 15% since the beginning of the crisis. In Canada, we also expect the oil sands sectors to expand to experience difficulties, and it will not only be felt by oil producers in North America, but also by oil service company in North America. So this is also one of the sectors that we see as being in very high risk of business default in the months to come. One other sector that we decided to downgrade is the construction sector. If we can move on to the sector to the next slide, you will be able to see some more details on that sector more specifically. So you can see that as a result of the crisis, well, business construction activity in the first 7 months of the year collapsed quite substantially by more than 15% in total. And it's been driven by the suspension of many construction projects to comply with stay-at-home orders and with sanitary measures. So this is one of the sectors that we can expect that has been one of the most affected by the lockdown period, and it's justified why we decided to downgrade that sector in the second quarter of 2020. We also foresee some difficulties for the sectors because, well, we expect public spending, especially on infrastructure, to be constrained in the months to come as a result of swelling fiscal deficits, both at the federal and local level, both in the US and Canada. So that will be a main constraint on infrastructure development in the months to come, and will weigh on the overall construction sector. We also expect lower demand from the commercial side, as demand for office spaces will probably be lower in the months to come as a result of more people teleworking. But one bright spot so far in the recovery, and that has been bucking the trend of the construction sector and of the overall economy, has been residential construction. As you can see from the left-hand side chart, residential building starts and the value of residential building starts has only declined by 3.5%. It's because it experienced since June a very rapid rebound in new housing starts, and that's what you can see on the right-hand side chart. You can see that the housing starts are already back to their levels that they had prior to the crisis, and these levels are exceptional. They are standing at 13 years high. The levels of housing starts is at a 13-year high, and the reason for these very good health of the residential construction sector is because of lower mortgage rates and record low mortgage rates that we've seen. In addition, demand for new construction and for new housing construction has been supported by a low stock of existing homes. So that's what is driving this residential construction. So it's been a good surprise in terms of the recovery. But we also remain cautious on this recovery. First, because the unemployment rate remains very, very high, and we do expect that it could weigh on demand. But mostly we expect that the margins of construction, of home builders and of construction companies will remain under pressure because input prices are going up as a result of this very sound recovery. So and this increase in input cost is mainly driven by the increase in lumber prices. Softwood lumber prices have more than increased twofold since the beginning of the year and are standing at a record level. The softwood lumber and lumber framing accounts for about 1/5 of total home building, according to the National Association of Home Builders. So we do expect that in the months to come, it will weigh on the residential construction segment and on profit margins of home builders. So that's why we remain cautious on the construction sector. So thank you for your attention. This is with this focus on the construction sector that I wanted to conclude. We can now open the floor to questions and answer. Again, if you want to see the slides and if you want to download the slides, they are now available in the handout sections, and you will be able to look at them. And I'll be more than happy to reply to your questions now.
So I remind everyone that there's a question pane here available on the webinar, so please ask your questions. Ruben, we do have a few questions here. The first question is, it was a little unclear what you meant. Maybe you can elaborate a little bit on the term full recall unemployment rate.
Yes, so what we've seen as a result of the pandemic is that a lot of people were laid off, but only temporarily, meaning that because some stores had to close their operations, well, people were classified as being unemployed. But as economies reopen and as the US economy and Canadian economies reopen, people are called back to work, and that's gonna help to support the recovery in the unemployment rate. So if we account for the total number of people going back to work and that were temporarily laid off during the months in the past months, well, we obtained this full recall unemployment rate. Is it clearer if I present it that way?
I think so, thank you. So do you expect the inflation to further increase?
We can expect inflation to further increase in the months to come. So for those of you who don't have the inflation figures in mind, in April, as a result of lower demand, inflation figures fell to a very low level of 0.1%, and it has since recovered as the economy reopened to 1.3%. So we can expect inflation to continue increasing in the months to come, because we will see improving demand from the lows that we have seen in the past. So this will drive an increase in prices in the months to come. The increase in prices will also be driven by increased prices in commodities, because and especially in energy prices. We are already seeing more stability in terms of oil prices, even though they're still quite low at about $40 a barrel. Well, they are still higher than they were a few months ago, and with the reopening taking place, we can expect these oil prices to continue to increase, and they are going to continue to feed into inflation. So it means that we will probably have inflation that will continue to increase. It will even probably exceed 2% at some point. And that's why the Federal Reserve decisions to amend its monetary policy framework in last month is very important. It's because in the months that will follow the recovery, what we will see is that the inflation rate is likely at some point to exceed the 2% target that is set by the Federal Reserve. And with the monetary policy framework, the Federal Reserve is giving itself more room for maneuver for keeping interest rates low, even though inflation increase above 2% for some time. Because if demand remains, and if aggregate demand remains constrained in the context of the post-COVID-19 recovery, well, inflation rates will be constrained below 2%. So we do expect what's the key message is, we do expect an increase. At some point, it might peak above 2%, but in the medium term, meaning by mid-2021, it will likely stabilize below the 2% target that it was set, that is set by the Federal Reserve.
Okay, thanks, Ruben. We're getting a lot of questions around different sectors. So we'll start here. You had mentioned that the agri-food sector was listed as a high risk.
Yes.
Could you elaborate a little bit on that, especially compared to some of the other sectors?
Yes, so the agri-food sector is in high risk in North America. It's mainly a result of difficult positions in the agri-food sectors before the pandemic. So we believe that the agri-food sector is in a difficult position for first, one of the aspects behind the high risk is low grain prices that is weighing on the sector. And in the case of the U.S., we do expect that the purchase of agricultural goods that are committed by China will not be met. So it means that exports and demand for these products will remain quite constrained. Also, what we've seen in terms of in the agri-food sectors is that we've seen a lot of companies operating in the agri-food sectors and a lot of agri-food manufacturers being in a difficult position as a result of the closure and of restaurants, and restaurants continuing to operate at constrained capacity. Because restaurants continue to operate at low capacity right now, it means that demand for some categories of products remain low. So that is having an impact on some agri-food manufacturers that are particularly exposed to this segment of the agri-food sector. I would also add that we do see that there are some risks to the supply chain, not to the supply chain in the agri-food sector because of lower migration in North America, in the North American market. Well, transportation and movement of people is constrained as a result of the pandemic, but in both Canada and the US, the agri-food sector depends very much on this workforce. So it could create some disruptions into the agri-food sector, and we actually seen some disruptions in the agri-food sector. So that's why it seemed appropriate to have the agri-food sector in high risk.
Thank you. The chemical market is another area where we're getting some questions here. So what can you say about the economic recovery regarding the chemical market and traders of such products?
So for the chemical market, so for the sector as a whole, we decided to downgrade it, even though there are some sectors that are going to fare better. So obviously in the chemical sectors, well, when you look at hand sanitizer, for instance, well, obviously if you're looking at these very specific products, well, demand in here is going to be high, and it's going to support the sector as a whole. But when you look at our view in the second quarter, we downgraded the automotive sector in very high risks, and we continue to believe that the automotive sector is going to experience a very difficult situation in the months to come in both the US and Canada. And when you look at the situation in the construction sector, well, we can expect that demand for chemical products that are in these two sectors is going to slow down. So this is one of the main reasons behind the downgrade of the chemical sector into high-risk. But what I want to insist on here in the chemical sector is that there are very diverging trends in terms of depending on the segment of the chemical sector that we are experiencing. So if we're looking at petrochemicals, for instance, well, lower input prices might be somewhat supportive of higher margins in North America. So that might be good. But lower demand is our key concern, especially lower demand in the automotive and construction sectors. So that's why we decided to downgrade these sectors into high risk.
Thanks, Ruben. We're also getting a few questions on the so-called trade war between the U.S. and China. So, do you expect an increase in U.S. tariffs against China?
I don't think so. That's not our core scenario at Coface. As you can see, as a result of the Phase 1 agreement, tariffs have slightly declined in February, and they remain quite stable since then. But they remain still very high at about 20%, at about 20%. What we've seen in the past months is that the US-China tensions were not so much on the trade front, but was developing on other fronts. So there are some concerns on the use of intellectual property that is prompting sanctions on both sides of the border. So there are the concerns on Hong Kong that are also prompting sanctions. So what we can expect is that actually these sanctions, they move from tariffs, which are already very high, and where there is not much room for maneuver to increase again in the next few months. And also it will depend very much on the next administration, but it might evolve in a direction where the main concern is sanctions and financial sanctions targeting Chinese companies, and it will be more and more companies, more and more Chinese companies and Chinese officials will be under sanctions that will make business very difficult with these companies and with very specific companies, including very high-profile companies like Huawei, and not so much on the tariff front. So that's why I don't see an increase in tariff rates, but I do see, but tariff rates are going to remain elevated, and we'll see more tensions on other fronts.
And what impact with this trade war with China do you think will affect the inflation rate in 2021?
So it's difficult to say because we don't know exactly how these tariffs are going to evolve in the next months. What we've seen so far with the increase in tariffs is that a lot of the increase has been absorbed by companies. So it means that companies accepted to take lower margins, and it was not felt on consumer inflation. But should these tariff rates remain elevated, and should margins remain under pressure as a result of these tariffs and of the consequences of the pandemic, well, we can expect that there will be some kind of increase in prices and an increase in consumer prices in 2021. But as I mentioned when I answered this question on inflation, in the medium term, we do not expect inflation to sustainably exceed 2%. So it should remain in check, even though there will be some upside pressures arising that could arise from the US-China trade war.
Thanks, Ruben. So it's no secret that the retail space is struggling, and Coface, it is an area where Coface is definitely reducing its coverage. Are there any plans to ease up on any specific retailers in general, or increase coverages in areas?
So in terms of coverage, I'm probably not the best person to answer that question, but we have a very detailed approach when it comes to our underwriting and to our coverage. We obviously take a look on a case-by-case basis, and there are some diverging trends in the retail space as well. So obviously it comes into play and into mind when we make decisions whether or not the segment of the retail sector is deeply impacted or not. So just to give you an example, well, we don't have the same view on retail of clothing than on the retail than on big box retailers, which have fared quite good during the crisis and fairly good during the crisis. So these elements are taken into account, but it's on a case-by-case basis. And again, if you have any questions regarding your coverage and how the decision was taken, well, you can contact the commercial department at Coface, and we can give you more details on these decisions.
Thank you. Do you expect the Fed to keep interest rates at the current level over the next 5 years?
Well, next 5 years, it's difficult to tell. But if we look at the last press release and that the Fed had, well, it's clear that we should not expect, at least before 2022, any rise in interest rate. So it means that interest rates in the US are likely to remain between 0 and 0.25%. And as I mentioned in the first question, the Federal Reserve has somehow tweaked its monetary policy framework. And one of the consequences of this change in the monetary policy framework might be that the Federal Reserve might be somehow more dovish and will wait to have solid evidence that the recovery is here and that there are pressures on prices before they increase interest rates. So that's why I believe we should. To me, it's quite, at this point, it's quite clear that there will be no rise in interest rate by the end of 2020. I'm 95% sure that there will be no interest rate rise in 2021. But going beyond going beyond 2021, it's quite difficult to say. We've seen after the 2008-2009 crisis, it took about 5 years before they start increase interest rates. So the first increase rates was in December of 2015. So that it can give us a hint on when they might increase interest rates, but the recovery from this unprecedented shock is different. So it might mean that we reach potential growth we reach U.S. potential growth sooner than after the Great Financial Crisis, and it could mean that interest rates might increase. The Fed might decide to increase interest rates sooner than in the 5 years. So I won't go. I wouldn't give a forecast in 5 years, but through the end of 2021, my opinion is that I'm 95% sure that they will keep interest rates unchanged.
Thank you, Ruben. I think we have time for maybe a couple more questions here. The US dollar has been depreciating against the euro. Do you think this trend will keep happening, or will the US dollar stabilize?
So we don't produce actual forecasts for exchange rates. So I'm not going to give you exact figures in terms of what will be the exchange rate in 6 months. What we can expect is that definitely the demand for US dollar will be lower in the months to come, and it will put downward pressure on the US dollars. Uncertainty surrounding the elections could also put downward pressure on the US dollar in the months to come. So there might be some weakening dollar on the card in the next 2 to 3 months. But going beyond, I think that we can expect the exchange rate to stabilize when the pace of the recovery becomes a little bit clearer. But for now, it's very difficult to know because we are in a phase where the recovery is very uncertain, and a lot of the demand for the dollar will depend on the recovery. So that's why so far what I can say is that downward pressures in the month to come for sure, but then in 2021 I would expect it to stabilize somewhat.
Okay, thanks. Let's see here. There are quite a lot of questions and some good feedback we're receiving here from the audience. Here's one. With the development of a COVID vaccine, what would be the potential impact on the US GDP?
Well, that could be a positive impact in terms of depending on when the vaccine is available. But we remain cautious on that point because if a vaccine is indeed developed, it might take some time before it's available to the wider population. So it's very difficult, and that's why I mentioned in one of the first slides that it depends a lot on the evolution, and the economic scenario depends a lot on the evolution of the pandemic. Well, the development of the vaccine comes into play, and that could be a positive development because that would mean a more rapid recovery because less restrictions and less sanitary measures. So that could be positive for some sectors of the economy, and quite notably the transport sector and the tourism sector. But we remain cautious because we don't know exactly when it's going to be available, and more importantly, how it's going to be distributed. Because right now we're seeing a lot of contracts being signed, a lot of announcements on vaccines being ready or almost ready, but it's not very clear when the wider population will be immunized to COVID-19. So that's why it's positive, but very uncertain.
Thank you, Ruben. Marco, I think we're out of time. Shall we wrap it up?
Yep. So thank you very much, everybody. There's a lot of questions we were unable to answer, but thank you for your attendance and your questions. Ruben, thank you very much for your presentation this afternoon, and thanks everybody for attending. Just a reminder, we do have the handouts in the handout pane. You can download that before the end of this presentation. Thank you very much, and enjoy the rest of your day.